Hello, all. Bob Pisani here. Welcome to ETF Edge, your go-to place for everything exchange-traded funds here. SPACs and active management are topics today, and all this craziness in the markets here. Three of the best in the business with us. Bob Shea is the TrimTabs CEO. Ben Johnson is the head of ETF research at Morningstar, and Mark Yusko is the CEO of Morgan Creek Capital Management. Bob, I want to start with you. There's a lot of craziness in the markets today. We were just talking about it on air. You were the head of Goldman Sachs equity desk for 14 or 15 years. You've seen a lot of craziness yourself here. We saw today Apple getting thrown around like a rag doll. It was 136 to 145 at an hour for the biggest company in the world. GameStop goes parabolic, then all the way back down, halted numerous times throughout the day. What do you think is going on here? There seems to be a little bit of a market issue with concerns about the COVID vaccine narrative changing a little bit. Some concerns maybe the stimulus program is not as certain or not as big as people think. And other people are saying, well, there's a sideshow going on with people trying to play the lower price stocks and the stocks that have been heavily shorted. Can you spend a minute and just sort this out for us?
Yeah, terrific. Thank you. First, thanks for having me, Bob. And yeah, I ran Goldman's equity trading desk back in the dot-com days as well. My desk was Cape Canaveral for a lot of the dot-coms, and as we've seen, there've been a lot of people writing and talking about the similarities between them then and now, and there are definitely some similarities, no question. But there are some big differences in the environments. But specifically to kind of the action we're seeing today, I think we're seeing, definitely speculative activity that's more based on positioning, options positioning, and shorter-term euphoric kind of sentiment, and we're seeing that bubbling up. Obviously, we have money supply, which is making new highs on a regular basis. And so on the one hand, there are some similarities. On the other hand, there's some glaring differences from back then. The interest rate environment is completely...
Well, yeah, I guess, and feel free to jump in, Ben or Mark, but the similarity that I see is people are still reacting to the same euphoria. This manias still happen. That dopamine rush that people still get in their heads that we saw so notably in 1999 when you were around, Bob, and I was reporting on this as well, hasn't changed. A whole field of behavioral economics came out of a lot of this, studying how people react to euphoria and to manias, and how people react to bubbles in general. So that certainly sounds very similar to me. What's different is the technology is very different. When people opened their DLJ accounts in 1998, it was pretty cumbersome. You could get a confirmation. It would take 20 minutes to move the next day. Today, you're sitting in a bar with your boyfriend or girlfriend and your Robinhood account, and you trade stocks like you're on FanDuel, like a sports game almost. It has similarities. Isn't that the difference here this time? It's a lot easier to do this.
Back then we had chat rooms, if you remember, for the IPOs where we price something at 30, but it would open at 200, and that's where there's some similarities. You have where there are these little pockets of what we're seeing in these short squeezes. There's definitely some speculative activity. What is most glaring right now is kind of the one-sided options positioning, where perhaps some of the cohort of investors that you were speaking to earlier are using leveraged options plays to express bullish views in a lot of these stocks and a lot of kind of the Nasdaq. What's very different is the interest rate backdrop. Very different. What's very different, we focus on free cash flow at TrimTabs, and I'll just tell you that the Nasdaq 100 from 2000 to 2021 is very different. From the percentage of the Nasdaq 100 that is free cash flow or cash flow positive is 99% versus 80. Free cash flow margins and free cash flow yield just much healthier. Now, does that mean we can't correct? Absolutely we can, but the speculation, it's not like if I look at the big glaring divergences that occurred towards the end of the 2000 into 2001, and they just don't exist with regards to credit spreads, et cetera, and big breadth divergences. Yeah. What we have, and I'll finish on this, is literally that what we have is this. It feels like the beginning stages of a long-term recovery on the one hand, and then this kind of very speculative action that we're seeing in the last few days.
Yeah, that sounds right to me. Mark, I want to talk to you about SPACs, but I wonder if you can react to what Bob was saying there. I think he brings up a good point. There's obviously the start of a long-term recovery, and yet today it feels like a blow-off top, kind of, in a way. I know we're supposed to talk about SPACs here, but any thoughts about what's happening right now?
No, we can definitely get to SPACs, but definitely have a reaction in that, the gamification. I think it's interesting that we're talking about GameStop all morning in a world where investing has truly become gamified. People were in lockdown. They couldn't bet on sports because sports wasn't happening. And suddenly DraftKings and others got people's attention focused on the market. So I do think we're at a speculative peak. I do think this could be, we don't know, but it could be that event, that seminal event that triggers some motion downward. But it is pretty wild, Bob. You're right.
Yeah, Ben, your thoughts. You're an old hand. You've been watching the markets for many years as well. How does this kind of is it a blow off top in your opinion right now, or is something else going on? And how does it affect the world of ETFs?
Yeah, Bob. I think the key term that Mark hit on is gamification. In what might be different today versus what we saw in 2000 is exactly what you've described. The fact that I can walk around with a supercomputer in my hand, make trades and make options trades all day, every day. In some cases, maybe allocating capital that arrived to me via a stimulus check into the markets, and see a little animated confetti drop out anytime I make some money in the market. That I think is only played on and really exacerbated all of those animal spirits, all of the worst of our behavioral biases this go around. And I think it's gotten to the point where, many professionals, many people watching the market, myself included, have gotten to the point where we're wondering, are we the crazy ones in all of this, or are we missing something that all these other people aren't? And, usually that's when, if you can't ring a bell at the top, it's probably a good time to start ringing it close enough to the top.
Yeah, we are. No, you're not crazy. And the answer to all of this is we have seen this before. And I feel like launching into, behavioral economics 101, but we don't have the time to do that. But this was all very well studied over the last, beginning about 1980, by people like, Robert Shiller and other people like that, and won Nobel Prizes for what's going on here.